Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I am your host, Juan Vargas. Today on the show, we have Devin Elder. Devin Elder is a San Antonio native and graduated from the University of Texas at San Antonio with a bachelor's degree in business administration. He got to start in real estate investing with single-family rentals and later scaled to multifamily investing. His company, DJE Texas Management Group, now controls 660 units worth $50 million. Devin, welcome to the show.
Well, hello. Thanks for having me, Juan. I appreciate it.
Yeah, thank you for taking the time and making this happen. Let's get this show started and tell us a little bit more about your background and tell us where you're calling us from.
Yeah, so I'm in San Antonio, like you mentioned. I was born and raised here and started investing in 2012. So I like this city. I have a family and I like living here. There's been some really fantastic developments in this city. A local billionaire entrepreneur about, 5-6 years ago, revamped this defunct brewery and surrounding areas near downtown San Antonio. They spent a fortune on it, and it's this beautiful facility called the Pearl. And that was kind of the start of this renaissance for San Antonio that happened 5 or 6 years ago. So growing up, there wasn't always like a lot of things to do, or you might go to a city like Austin or a bigger city like Chicago or California or Los Angeles, whatever it is to do things. But San Antonio's kind of grown, and there's some cool things to do here now is my point. So that's great to see in the last couple of years. There's lots of stuff to do for the family. And then it also happens to be, my backyard where I know, every street in the city almost. I've probably invested in every zip code in this city.
Doesn't get any better than that, right?
Yeah.
Whenever you actually know your backyard and you can know the difference between what's a good submarket and whatnot. If you're investing remotely, then it's kind of hard to tell that. That's something that is a disadvantage to you a little bit. You have to rely on other key members, but for you, being that it's in your backyard, then I'm sure it'll give your investors a lot of more confidence as well. But we'll get to that here in a little bit. But yeah, go ahead and proceed.
Yeah, so it's nice now that I'm a real estate investor that I know the city well, and that it's a good market. I mean, that's just pure dumb luck on my part, having grown up here and gotten into real estate in 2012, and now, it's great market for multifamily investing, and so I'm just trying to capitalize on that. And like most multifamily investors, I think the bottleneck is really kind of the deal sourcing. We look at a lot of deals, we underwrite a lot of deals. Overwhelming majority of them don't make sense to buy, and every now and then we find a gem and we try to pounce on it. So
there you go. Okay, well, tell us a little bit more about your background and when did real estate even cross your mind? And I know that you had a corporate job before this, knowing a little bit more about you, but when did real estate even cross your mind, and why did you decide to get into it in the first place?
Yeah, it was 2008, I remember, was kind of a pivotal time for me. A couple of things happened. I lost a lot. I was doing, working in a corporate job. Our first child was born in 2009. So I was kind of getting ready to start a family and working the corporate job, and figured I would just kind of go up the corporate ladder. But a couple of things happened. I read Rich Dad, Poor Dad that year. I read 4 Hour Workweek that year, and I lost half of my retirement account in the market crash in 2008. So all of those things were kind of going on in that year. At the same time, I was going, do I really want to be my boss's boss? When I'm looking at my career path, do I want to be the guy that lives at the office and is stressed to the max? And I didn't. And so the 4 Hour Workweek and Rich Dad Poor Dad had this profound effect on me. And so I decided to start trying to look for ways to replace income. And it really took a few years before I actually invested in my first single family rental. And that was in 2012. But I had made the decision by 2012, after I did that first real estate investment, that was going to be my vehicle out of the corporate world. So I worked really, really diligently for about 3 years in the corporate world and building my real estate portfolio to where I could replace my income. And I will not say that was an easy time. It was, but it's almost like I was possessed. I was obsessed with getting out of that corporate job.
Yeah.
And because I could see, I'm sure some people can relate to this, but I could see that as I would get promoted in the corporate world, things would get a little more comfortable. And I just thought in my mind, I'm 1 or 2 promotions away from being stuck in this corporate world till I'm 60 years old.
Yes.
If I start making any more money, it's going to be real hard to walk away. And I have a lot of friends in that position that they're just too comfortable. And so I think that level of comfort is the enemy. And I think it's very difficult to break out of the inertia of that corporate world. So I was on a mission, and then it finally, I was in my mid 30s and I said, just drew the line in the sand. It's all the cliches, burn the boats, make the decision, decide, commit. And I did it. And I left myself no other choice but to succeed as a real estate investor. And I honestly think that's the difference between the people that build a successful investment career and those that don't. It was a 100% commitment. And I have faced every kind of challenge you could imagine in that time, but I never once considered going back to a job. I just said, this is just another test, or this is another lesson. But there's, it was that 100% commitment with zero margin for any other thought. And anyway, all that is to say, I did build up the real estate portfolio. I did quit work, and then have been building my multifamily real estate portfolio the last couple of years. And it's been great because I knew that once I was able to get out of my job, that I would have all this freedom of time and energy to grow the business a lot more. And that is what happened. It was the scariest thing I've ever done in my life, but that's what happened. Is I was able to start devoting lots more time to going to conferences, to meeting people, to touring properties, to getting educated, meeting investors. I mean, all the things that you do as a real estate investor, was able to really do it full time. And that's paid off quite well.
Yes. I love that. I love your story, and I can relate, to your story as well, because like for me, it was kind of similar. And so for me, it was a full commitment as well, and you can kind of get trapped in your job, and, if you don't see the other side of it, then you will get trapped. And as you make more income, then it becomes harder for you also to leave, because now if you're trying to replace your income with the, assets or cash flow, then it becomes a little bit more difficult, because you're making a little bit more as you go up the ladder. And so it becomes harder for you to even leave. If you're at the bottom, then, okay, big deal, then, you can move on from place to place, or just start from the bottom, right? But if you're towards the top, then it becomes way more difficult. So, you can see it as a blessing, but then you can also see it as, it's not a blessing. You got to do something about it. And so I like that you were, 100% committed, and you went, full force into it, right? And hit it first. So, so you started off basically with single family. And so what kind of single family was it? Were you doing flips, or were you doing rentals, or what was that?
Yeah, I had a pretty clear-cut trajectory. My initial goal, I guess you call it phase one, was to replace my income. And so I did that by buying quite a few single family rentals. And what I would do in the very beginning, my first deal, I used hard money, bought a house that needed a lot of work, but the hard money gives you the purchase price plus the rehab dollars, pretty much all of it. Rehab that house, put a tenant in there, and refinanced it. And I think I had $8,000 out of pocket on that first deal. So to me, that was a magic trick. I said, wow, I own a house for $8,000. It's cash flowing. It has equity. It's appreciating. I'm getting depreciation, tax advantage, all the advantages of real estate. Now it was real. I said, okay, I want to do 10 of those. So I did 10 of those. And I did it with very little money, all things considered, because I would borrow money, renovate it, and then refinance out all of my money or most of my money. And then I started getting private loans, which are a little easier to work with and maybe a little cheaper cost of capital. So I ended up building a rental portfolio of 20 some odd units that, including a small multifamily, that was able to replace my income. And that's when I pulled the plug on the job. And then the goal the entire time was to be able to get into multifamily. Very early in my career, I did not feel comfortable raising capital from others. What really made me comfortable raising capital, and I raise millions of dollars of capital now for these multifamily projects, but what made me comfortable was that the first private loan, where somebody loaned me $150,000 with a first lien on the house, and getting them paid off in 6 months. And wow, the lender made a great return. And so, with that lender, I've probably done, 50 projects with that lender over the years, and borrowed millions of dollars from that lender, and started borrowing money from all these other people. So after a number of years doing these single family projects, and I did get into flips at some point, I realized, hey, I've raised millions of dollars of capital. It's just been 150,000 at a time. But you start to do dozens and dozens and dozens of projects, and you go, well, boy, I've raised millions of dollars. I've returned it all. All my investors are happy. I've never, defaulted or lost a house or even missed an interest payment for anybody. Everybody's happy. They're all taken care of. And so that's what gave me the bridge of confidence to say, okay, we've got a multifamily project here that's a $2.5 million capital raise. And I've raised more money than that before. It's just been spread out over multiple projects. And the argument could be made that it's almost easier to do on the in fact, I'll say it is easier to do on the multifamily. You got one address, the bills come to one place.
Yep.
You got professional third-party management on it. You're not chasing 20 rentals all around the city with 20 different tax bills to pay. It's just a lot more scalable, as you and I both know. But that was my transition that gave me the confidence to be able to say, I can raise capital for these multifamily projects. I'm going to build the right team around me. I've already done lots of capital raising. We're just going to kind of consolidate it into one project. So that was my bridge into the multifamily world. And that was always the goal. It's just, as these multifamily projects will require some substantial balance sheet,
Mm-hmm.
some decent liquidity. And when I started my investor career, I didn't have that stuff. So it took me a few years flipping houses, wholesaling houses, rental income, selling some of the rentals, all that stuff kind of piled together, saving my own money from the job and stuff like that. And to the point where I finally say, okay, I've got a decent enough balance sheet and liquidity to go out and start taking out some multifamily stuff.
Yeah. So you did the natural thing, basically. I think a lot of guys, they start off in single family and then, they have a goal of getting into multifamily, and you had that goal of getting into multifamily, but you start off with single family, which, like you said, it proved to be a good thing because you created a track record of getting in and out of these properties and raising capital. So then that also gave you more confidence, as well as your investors, whenever you went to that first multifamily property or the larger multifamily property that you had to do a $2.5 million raise. So speaking of that property, how long ago was that first property or that first capital raise for that bigger project? How long ago was that first, and where was that one located?
Yeah, so my very first multifamily project was a small little 6-unit that I bought by myself. I put, I think, $35,000 of my own money in it, which wasn't very much, and the bank loan for the rest. And I ran that for a couple of years because I just wanted to do it all myself. I didn't enjoy running it. It was kind of a C- deal and, kind of a rougher area of town. But boy, I did it all, and that gave me some confidence. The next deal was a 75-unit in San Antonio that I bought with some partners, and that was about a year and a half ago now. And so that was a complete renovation. And then the most recent project was 100, I'm going to call it 130 units because it's actually 106 units that I'm converting to 130. And that project was earlier in the first quarter of this year that we.
Okay. Well, let's talk about that 70 plus unit, and then we'll talk about this 130 unit now. But yeah, let's talk about the 70 something unit. How'd you find that property? Obviously you're in the San Antonio market. So I would say, it's in the San Antonio market, one of the submarkets. And what was the capital raised on that project? What was the purchase price? Tell us a little bit more, the details on that project.
Yeah, so that one was an off-market deal that was in really bad shape. Frankly, about the worst shape you could imagine in terms of deferred maintenance and the tenant base there. Tons of drug activity happening. It was billed as a 70% occupancy, which wasn't even close to that in terms of economic occupancy. There were people living there that had been living there 6 months and had never turned on the utilities because they couldn't, they didn't have the credit to turn on utilities. So almost people just squatting there basically.
Yeah.
It was pretty incredible in terms of how bad the property was. Now the area is not the greatest in San Antonio, but it's not bad. There's, the property was here and all the neighborhood surrounding it was decent houses, 60s construction houses. People, took care of their lawns. It's an older demographic over there. It was really like this one property was why the area was bad. Like, there's schools and churches and a nice neighborhood, and then this property. And that's why the whole area is the ghetto. Because of
that one property.
You just wouldn't even want to walk there at dusk. I mean, seriously, like after takeover, you didn't even want to be there as the sun started to go down.
So it was like the worst property in the neighborhood, so to speak, and so, yeah, I want to say real quick is that, if you find the worst property in a good neighborhood, or, above average neighborhood, then that's a property that you might want to go after. If you find, a property, the best property in a really bad neighborhood, then that might be something that you might want to look, away from. So go ahead
Yep.
and tell us the story on that.
Yeah, so that one was like 32 a door on the purchase, and
Nice.
we raised 15 a door for the capital improvement, which is pretty high, and went in and really touched everything down to the sheetrock. So new floors, new cabinets, new counters, some roof work, perimeter fence, new pool, exterior paint, redid the office, paved the entire thing. I mean, the property's 1,000 feet long. We put an entire new driveway in. I mean, really, like, there's nothing that we didn't touch.
Yeah.
So it's a nice property now. It's really, really nice looking. But that was like on the most extreme side. And so the capital raise on that, I think, was 1.2. I'd have to actually look it up. Sometimes I feel like my brain gets so full, I'm relying on my stuff in Google Docs.
Yeah.
I back up Google Docs with 2 other services, because if I ever lost it, I would be ruined. So sometimes, my wife will ask me, or a business partner asks me something about numbers. I'm like, it's definitely recorded. My hard drive's full up here. So anyway.
Right. So what was the purchase price on that property? Because, putting in 15 grand, and you said that was like the worst property in the neighborhood, then,
Yep.
It's pretty safe to say that it was in pretty rough shape. So what was the purchase price at? 32 a door? I mean, I guess you could do the
like
math, but
2.3 and change.
okay. So
Yeah, and then
1.2
another
capital raise, okay, that makes sense. Yeah.
Yeah.
So have you already finished your renovations on that project?
Yep. Renovation's done, and we're doing our lease up right now. So, we expect to be full by the end of the summer. And that's when you kind of start the clock on, when is this property stabilized? If you're at 90, 95% by, end of the summer, okay, that's kind of when we can start the clock on being stabilized for, a refinance or whatever the exit is on that project.
Okay. And what are you expecting to get as far as rent bumps because of the upgrades and the renovation?
It's well over $250.
Nice. Yeah.
But I got to tell
huge.
you, it's only because they were so bad.
Yeah.
I mean, the neighborhood's okay. If you look at, a great neighborhood's here and the worst neighborhood's here, this neighborhood's in the middle, but the property was, off the charts low. So just bringing it up to, a standard a little high. There's really nothing like it in that little submarket or neighborhood. A property next to us got renovated, but they have window units, and it's really not on the level with this. So a $250 rent bump sounds impressive, but it's really just because it was so incredibly low before,
Yeah. Okay. So what is going to be your projected exit? Like, you're pretty much stabilizing the property now. What is your strategy there? How long are you going to be holding the property, and what do you expect to get like on the back end?
Yeah, I mean, it's probably going to end up being a 2-year hold with a 2x equity multiple, right? So,
nice. Yeah.
And
for those of you guys, for those of the guys that don't know exactly what that is, can you explain what the 2x equity multiple is?
Yeah, your equity multiple is just how much money you're getting out on your investment. So if I tell you it's a two equity multiple, you invest $1 with me, I want to give you $2 back.
2 times
in whatever time frame it is.
Yep.
If it's a 1.5 equity multiple and you invest $1 with me, I want to give you back $1.50. So
simplest terms. Yep.
It's a good metric. I like the equity multiple. I mean, I think the real metric is internal rate of return.
Right.
And, I'd have to, again, look at my notes on what the internal rate of return is. If you're getting a 2x equity multiple in 2 years, it's extremely high. But this is an extreme project. I mean, I probably won't do another project that extreme, maybe ever in my life. It was just a really wild project. Usually what I'm trying to underwrite is find something that can deliver a 7 to 10% cash on cash return, meaning if you give us $100,000, I want to be able to give you $7,000, $8,000, $9,000 a year in cash flow every, quarterly distributions. And then I want to be able to double money on a 5-year hold. That's really kind of more of a realistic underwriting. This 75 unit project was just a kind of an anomaly because it was such a monster and such a deep turnaround project.
Okay, got it. So I know that you have your criteria when searching for properties. One of the criteria is, you're pretty much staying in your backyard because that's what you know, right?
Yep.
What other criteria besides being in a war zone would you not, go into a property? Like if somebody sends you a deal and then you automatically see us in a war zone, you're like, you're not even going to touch it. But what other, key areas where you'd be like, you know what, I'm not touching this. I'm moving away from this project because it's not worth it.
Yeah, I mean, areas are a consideration. I mean, there's certain parts of the map that I know that I just don't even want to fool with. There's not many, though. I mean, if a deal pencils and it's on the south side of town or whatever, I mean, it's really dependent on the numbers, So I'm not going to – I would say that the area is not my number one concern. I mean, there's definitely some no-go zones in my market that I won't touch, but I'm really more looking at the numbers and is there a value add component there? I'm also, part of my criteria is I'm looking for 100 units plus because you just start to get some of those efficiencies on management. You've got better payroll numbers. You can hire full-time staff. The management companies like them better. They like to manage those bigger properties better. You've got economies of scale and things like that. So I'm looking for 100 units plus. B and C. I mean, we put some offers out on some nicer, newer properties recently that we didn't end up getting awarded. It's just real hard to make those pencil without some kind of a value add story. I've got to see a value add story where occupancy is really low, or the property hasn't been updated in a really long time, or there's just some very obvious management issues that need to be corrected. Because you just have to be able to force equity into these projects. In my estimation, I mean, if you're trying to get 7 to 10% cash on cash returns and double everybody's money in 5 years, there's just got to be some kind of mismanagement there or something that you can go in and fix. I mean, the same thing that I did with the single family houses. I was never buying a nice house. It was always there was never a good story on a house that I was buying. It was always some kind of terrible story of fire or divorce or back taxes. It was, and the houses were always trash. So kind of looking for the same thing in the multifamily world where, where's the story where we can go in and spend $1 million, $2 million on a renovation and force that equity and not count on appreciation look, San Antonio market trajectory is going great, but I'm not underwriting that it's, always going to be great like that. I want to be able to, on the front end, go in and prove something that we can go in, like this most recent acquisition. I'm adding 24 units to the property without adding square footage. I mean, that's such a kind of a layup of a value add story. And that's only one piece of the value add on that. So that I feel very good about being able to go in and say, look, we're going to force some appreciation on this project by proactively going in there and spending some money doing some renovation.
Love it. Love it. So I want to talk about this latest project, the one that you're adding these 30 units. I mean, how does that even happen? Like you have just a big area that just wide open and you're just, changing them into units or I mean, how would you even think about even doing that?
Yeah, I'm actually doing it without adding square footage. And it's really a bizarre deal that I underwrote this deal at 106 units when I first came across my desk. And it made sense. So, okay, let's get it under contract. And then and I'd done a preliminary tour, but on the due diligence tour, once we were under contract, I started noticing all these units with spiral staircases. And then during the walkthrough, I said, but these spiral staircases are weird. This can't have been built this way. And then I noticed that they were calling them 3 and 4 bedroom units. I noticed that it was just on a 2-story building.
Okay.
It was a 1 bedroom and an identical 1 bedroom floor plan below it. And they had just connected them with a spiral staircase and made the upstairs kitchen, gutted it and made it a bedroom. So it was a real shoddy 4 bedroom, you could call it. And I just said, well, hey, I'm sure, we ended up cutting some of the drywall out during our due diligence. We asked the owner, hey, can we cut up some of your walls on some of these? I'll patch it. If I don't buy it, I'll patch it up for you.
Yeah,
I'll give you
right.
money, whatever. So we got out there, cut open the sheetrock and saw the plumbing connections with the cutoffs right there. So we said, hey, we're just going to seal the floor, pull out these spiral staircases, convert these units back. So instead of having 24 3 and 4 bedrooms, we get 48 one bedrooms. And so the benefit of that is that now we've got a lot more units on the property. So when we go to sell or refinance or whatever, it's a 130 unit property instead of 106, which is good. And also, we're getting higher rent per square foot on those smaller units. It does change the unit mix, right? Now we've got a lot of one bedrooms, which could be good or bad, but it's more affordable. We've got a lower price point now on those units. So that was the game plan with that. Plus, I just did not like those spiral staircases. They just look dangerous to me, having kids run up and down these spiral staircases. And so we just went ahead and pulled them all out. We haven't done all of them, converted them all yet, but the plan was to get it all done in the first year. We're well on track to do that. So that was that value add component. Another value add component for that property was that the property was paying all the utilities, which is amazing. So they're paying electric, water. It was over $200,000 a year in utilities. So now what we're doing is having the electrics individually metered, so the tenants are paying their own electric. And then on lease renewals, we're also rubbing back, most of the water. And by rub, it's ratio utility billing. The property gets the whole water bill, and everybody gets a little piece of it assigned to them. So we're taking over $200,000 of expenses off the property shoulder. So that kind of thing where you can have that kind of an impact, we don't even really need a massive rent increase. I'm just adding a lot of units, and I'm taking that utility off the property, and we're just running it. I've got a professional management company running this thing instead of kind of a mom and pop approach that was there before. So all of those things add up to a pretty compelling story on what we're able to do on the value add. I mean, the appraisal came back almost $3 million higher on that property.
Nice.
Not the as is appraisal, but they're saying, hey, if you do all these things,
if you do all the work,
it's your after repaired value, if you want to use a single family language, is $3 million higher for, a little less than $1 million of CapEx. So, I like that story a lot. I'm excited to see that property transform. So that's the numbers side of it. But aside from that, creating this clean, functional community for these folks where stuff works and they feel okay that with their kids playing outside is just a great component of this whole business, is being able to kind of turn these communities around. It's always a part of it, and it's great to be able to do it.
I love it, man. That's multifamily investing right there at its best. I want to ask you, go back a little bit and tell us what the rent per square foot was, if you left it as is versus, implementing the one bedrooms.
Yes. So the rent per square foot jumped, I think we were it was in the 80s per square foot on the larger units. And then now we're up in the a little bit over $1.10. So that story made sense. We're getting a little bit of a rent premium, but the real key is taking the utilities off of the property,
right.
And taking that off the shoulders of the property. And so we're going in, we're doing a renovation, interior and exterior. We did a rebrand of the property, and either with renewals, and we've moved a lot of tenants around, like, hey, you want an upgraded unit, we can move you. Your rent's going to go up $25, not crazy, but you got to pay your utilities. And so people are good with that to live in an upgraded unit. So the real story there is a minor rent increase, but taking the utilities off the property.
Got it. So I want to talk about the future and, what you're looking at. Obviously you've had, what looks like pretty good success on these two larger, properties. What are you looking at? And as far as the San Antonio market, if you had a crystal ball, if you can, tell us what's going to happen in the next 3 to 5 years. I know nobody can, right? And it's all just, anybody's guess. But what do you see, since you've been there and you know that market well, what do you think is going to happen?
Yeah, so I'll play the game, because with the disclaimer that, don't play this back in 3 years when the world economy crashes.
There you go.
Devin had this rosy picture. So here's I have two hats. I have my underwriting hat, which assumes that Armageddon is right around the corner, and we better be in some long-term fixed debt where we can ride out whatever happens, right? If 2008 happens again, I need to be in debt on these projects that can withhold 5-10 years of hanging on for cash flow, right? Worst case scenario, because really the whole game for me is investor return driven. I'm the sponsor and I'm putting the deals together, but really I'm always looking at how is this impacting investors? Because that's my whole business is I'm basically a fund manager. Happens to be sheetrock and tenants and all this stuff with real estate, but I'm basically a fund manager. I'm taking on capital and I'm deploying it in these projects that I feel very good about making the projected returns. Anyway, so that being said, when I'm putting my underwriting hat on, I'm underwriting conservative rent growth. I'm underwriting cap rates going up by as much as a full point. I'm underwriting, not very good things happening in the future. However, I do feel like San Antonio is kind of uniquely positioned here in that we're still a very affordable market. We've had some things happen in terms of downtown development and continue to happen. I mean, there's 10 cranes up in downtown San Antonio. I turned 40 this year and I was born here and lived most of my life here. That's never, ever, ever happened. We're getting a new Frost Bank building downtown. It's the first skyscraper to go up in 30 years. So we're seeing some relatively rapid appreciation for prices and demand for some of this housing around downtown and things like that we've never seen in San Antonio. And while we're barely a tier 2 city, this city things are really changing just in the last 3, 4, 5 years. And so what's happening with some of the bigger developers here is they're really trying to create companies here in San Antonio, specifically in the tech sector, that can grow here and stay here, where people don't feel like they need to move to New York to build their career or move to Dallas. So that's all relatively new in San Antonio, and it's very exciting. And I'm not going to say that we're guaranteed to just be on this huge trajectory of growth, but we're at the beginning of some very exciting things happening in San Antonio in terms of economic development. And the thing I like about San Antonio, say, versus Austin is we've got the infrastructure. Our highway infrastructure is awesome. San Antonio is spread out. We're 1.5 million people right now, but you could put on 1 million more, and we have the highway infrastructure for it, and we're spread out. We're not like Austin is just suffering right now in terms of all the growth, and the infrastructure is just struggling to keep up with it. And we don't have that challenge in San Antonio. So we're almost primed for more population growth, more growth. And I'm not doing these sexy downtown skyscrapers, but I'm just doing little old B and C apartment complexes that have been mismanaged. And can we try to put some love in them, make them a nicer community, and get the returns for investors? So I feel very bullish on the San Antonio market in general, with the caveat that I don't have a crystal ball.
There you go. You got to make sure you say that for sure.
Mm-hmm.
Yeah, I love that because, we have been seeing that, as well, San Antonio is just growing, there's population growth, like crazy, add to the fact that, it's Texas, is landlord friendly, business friendly. You have, a bunch of, companies coming here, a lot of tech that's going into San Antonio, like you mentioned, so that's, anytime you have a population growth, there's always going to be a demand for affordable, well, I wouldn't say affordable, but, workforce housing or even affordable housing. So there's always going to be that demand. And if you're in the multifamily space, then, you should be okay. As long as you're underwriting your deals conservatively, like you said, you're doing a whole point higher on the back end, that's the way to do it. If you're being too aggressive, then that's how you could get burnt, So you always want to make sure you underwrite your deals to the, the worst case scenario. Try to see the worst case scenario. And, and if you still feel comfortable, then it might be a good project to go ahead and proceed on. So, how do you structure your deals, Devin? I mean, you put together these, couple deals, and, how do you structure your deals with your investors, typically, and what are your splits?
Yeah, so it's pretty standard split from what I've seen. I've gotten to know a lot of syndicators around the country, and I see a lot of deals, and I invest in deals. So I've seen a lot of these, and I think it's pretty standard. Typically on a what I call a smaller deal, let's say it's a $5-6 million kind of purchase price or total capitalization. Usually a 70-30 split, 70% to the general partnership. 30% to the general partnership.
Like, wow, that's a good deal for you.
So a typical split is a 70-30. On a much larger deal we've looked at, it might be an 80-20, and we haven't won any of those, $20 million deal, $30 million deals or whatever. I can't really make them pencil, but, typical deals that I've done, 70-30 split. Usually a preferred return, 7-8%. And preferred return means that the investors get paid first before any asset management fees or before the sponsor gets paid anything, you basically have to make the investors whole on at least the preferred return, 7 or 8%. And then over that is the asset management fee and anything to the investors. And then, so it's usually 7 or 8% preferred return, and then asset management fees paid. And then everything else, cash flow, refinance proceeds, sale proceeds is split 70-30 between the management and the limited partners. Now, occasionally, always, I've got a key principal on the general partnership with me, typically to get the net worth requirements where they need to be. I mean, as you know, the banks like to see net worth of the general partnership team equal to the loan amount. So if it's a $5 million loan, we need $5 million in net worth. And so I carve off a nice little piece of the equity to give to a balance sheet guarantor along with, myself. But the nice thing about that is these are non-recourse loans. So, I mean, it's just one of the many beautiful things about multifamily is a lot of times these are non-recourse loans, which is just fantastic. So usually there's a key principal involved and myself, quarterly distributions to investors, and then we do monthly updates. So where's occupancy? How's the renovation coming along? Here's pictures of the rebrand and the turnaround, and here's what we did with the office and the laundry room, just kind of a narrative of what's happening with the property every month. And then quarterly financials, so P&L, rent roll, and kind of a larger narrative on how the property's performing. So, I like to see that stuff when I'm a passive investor on the projects. And of course, I like to provide that with my investors. And then I always open the door. Hey, if you want to go tour the property with me, if you're an out-of-state investor, come see it. Or if you live in San Antonio, come see the property with me, introduce you to the staff and everything. Nobody really takes me up on that. I guess they like the passive part, and they see the photos, they figure. And look, if you're getting checks, it's kind of, all this communication stuff that I do, making this nice newsletter and everything for the investors, if the checks are coming, it's kind of like, all right. And I'm the same way on my investments. Like, are the checks coming? Because
that's what really matters at the end of the day.
That's kind of what matters at the end of the day.
Yeah. So, you got to make sure those checks are coming and, keep them happy.
That's right.
Definitely, let them know what's going on, even if it's bad news, let them know. But, definitely if they are getting those checks, coming in, quarterly, monthly or whatever, then, it's pretty safe to say that they're going to be happy, especially if you can get, higher than projected, returns.
Sure.
So that's always a good thing. So, Devin, I think it's time for our nuggets of wealth, and I think you have provided a lot of value here. So let's go ahead and get into our nuggets of wealth. And these are basically questions that I ask every guest. And hopefully that, our listeners can pick up on some key things and help them in their investing journeys. So let's go ahead and get that going. What is a key tip or advice that you would give to those who are wanting to take their business to the next level?
Yeah, I would specifically in multifamily, I would say that the right partners are just critical. There's a number of players. Your property management company is obviously just critical. So if you're already a multifamily investor and you want to continue growing that, I think finding the deal is the hard part right now. So focus your energy on that. If you wanted to get into multifamily investing, it's building that right team. This whole thing, these aren't just numbers on a spreadsheet. These are people doing the work in the trenches every day. And that's property managers, and your management company has such a vital role. Same thing, everybody's important, right? Your investors are obviously important. Your key principal is extremely important. You've got to have that relationship. Your debt broker is extremely important. Make sure you're getting the right debt on the project. And so, the key to multifamily, it's absolutely a team sport. You can be a single family guy, kind of Han Solo out there doing your thing, but on multifamily, you got to be a team player. And so just finding quality team members is the key to the whole thing. That's assuming you can find a deal that you can underwrite conservatively and actually buy. And that's obviously a challenge for folks in this market, in this part of the market cycle, but it's all about team,
Yes,
all
sir.
about team.
I love that. That's 100% accurate. You got to have the right team members, and multifamily, in single family, you kind of do a lot of the things yourself. And multifamily or really commercial real estate, having a team is critical. It's not just, maybe, it's not a luxury. It's a must, so you got to have that. And, you're always going to be weaker at one point or at one area versus another. So have a good solid team for sure. What is a good tool, source, or platform that you use frequently that can also help others?
Well, Google Docs is kind of at the core of my business. There's just so much there, and the shareability, things like that. I'm kind of a podcast junkie. I used to be a voracious reader, and I find myself reading less, but consuming 10 times the amount of content that I would before, listening to podcasts like yours and listening to other operators. I mean, it's just such a resource, and it's an obvious one, but that's it. And then, my team members are such a valuable resource. Loan broker and the wealth of information they have, and my property management company, they're a wealth of information. If you've got a property management company that's been doing something for 20 years, and they tell you, this should go this way, you heed that. You listen to the voice of experience there. And so it's, again, leaning on your team, and podcasts are phenomenal. At the end of the day, education only takes you so far, and then you got to flip the coin, and you got to go take a bunch of action. And you got to have both. You can't have one without the other. If you take action without education, you're going to lose a bunch of money, yours and other people's. If you do a bunch of education, you listen to 100 podcasts, and you never go invest in a deal, you're not getting anywhere either. So you have to have both, and you have to make the jump.
Agree 100%. Yes, that's 100% right. So what is the best business advice that you ever received?
Yeah, best business advice. Anything that I take this back to my very early teens reading Tony Robbins, and it's just been reiterated over my life. Any outcome that you want has likely been achieved already. Unless you're Elon Musk and you're building a rocket ship to Mars, that's new. He doesn't have any role model for that. But for everything else that most of us want to do in this life, fitness, finances, multifamily investing, somebody's already done it. Mm-hmm. And there's a model created for that. And so you find the person that's actually done it, not wants to do it or anything like that. They've actually achieved the result, and you copy them exactly. And it's going to feel awkward and unnatural, and you're going to question, why would you do it that way? But there's these models here for us that you can copy, and that will shave off, years or decades off a learning curve. So that's my goal with anything that I do, whether it's working on my golf game or multifamily investing or how I want to be with my kids. I look for a model of what I want exactly, and then I try to copy that exactly. And that's the key.
That's the key. Don't reinvent the wheel, basically, is what you're saying. Yes. Yeah, great answer. Yes. What book are you currently reading, if you're reading a book? Because I know you said that you're listening to a lot of podcasts and taking action, but if you are reading a book, what book is that?
Well, so I have The Go-Giver on my desk, which was a gift, and I have not started it yet, but that's the next book that I want to read. And then, I like, there's so many podcasts out there. You guys have a great podcast. I really enjoy the Old Capital podcast, which you're probably familiar with.
Yes.
Michael Blanc's podcast, Rod Cleef's. I enjoy all those. So I kind of have this ritual in the morning. I want to listen to business stuff. I drink my coffee, driving wherever I'm going. I kind of get amped up, fired up, and listen to some business. And then I kind of work on some different things, go to some projects. And then by the end of the day, I kind of want to listen to some music and turn my brain off a little bit. But usually in the morning, it's, getting after some business knowledge and letting it all soak in.
And that's exactly when you want to do it. You want to do it early in the morning, have a cup of coffee, like you said. That's when you're able to retain a lot of the information. You don't want to necessarily do that like late at night, right before you go to bed. At least from my experience, it's always better for me to do that early in the morning, and then start off the day with a punch. So it'll help you out, throughout the day. Where do you see your business here in the next 10 years?
Great question. So, can't predict the future, but I like to set very specific goals because they have a habit of miraculously happening. When I always look back and I'm just amazed at how you put something on a whiteboard or you write it down and it just happens. Do I know it's going to happen? No, but I like to set clear goals. So my goal when I started investing is kind of a few tiers. I wanted to get out of my corporate job, so I hit that goal, and then I wanted to get up to. So I had my fix and flip business, which actually I still have, but I've got a couple of fantastic partners that are basically running all of that. So still up and running. I just am out of the day-to-day, which is kind of the entrepreneur's dream on that business. So my goal was to get out of that business. Now my goal is for the next 5 years to acquire as much multifamily as I possibly can that makes sense. You know, if that's 2 deals a year, if I can find them, do it. If it's 3 a year, I'd love to find them. Finding them will be the challenge. I really want to give myself a 5-year horizon from age 40 to 45 to be the sponsor on as many deals as I can. And then when I get to that point, 5 years in, I'm going to start being a key principal, which I already am a key principal on some deals, and investing in other sponsors' deals. So the sponsor that comes up behind me that's a little bit younger, he's starting his career, or other sponsors that are out there just doing deals, I want to start to become 100% passive on that stuff. So I think I've got a 5-year window. I look at it like a football career, right? I mean, if you enter the NFL, you don't have a 20-year goal. You know, you got a shelf life of this long to go make it happen.
Mm-hmm.
That's what I see as my multifamily career. I want to really go make it happen over the next 5 years, make great returns for investors, make great relationships with other sponsors. And then, you know, right now my active investment is here and my passive investment is here. I'm a passive investor in deals, but over the next 5 years, I really want to shift that to where eventually I'm 100% passive. Mailbox money's coming in. I'm a key principal on deals. And then, you know, you get the snowball effect where you almost can't stop the amount of, you know, revenue that's kind of coming into this machine and coming in and out of these deals. So that's my goal, is hit it hard for 5 years and then start to transition out and maybe mentor some people, coach some people, be a key principal on other people's deals and invest in other people's deals. And you know, at that point, I think my golf score starts to creep down,
get better,
a little bit lower, you know, and then real big on spending time with my kids now and making time for that. But, you know, want to continue to do family stuff and keep that balance. And one of the things the whole reason I got into this thing is so I could call the shots on my schedule and have that life balance, and real estate's allowed me to do that. It's, you know, I talk to friends with jobs and I'm like, I can't even imagine being in that situation anymore. I mean, my days have their ups and downs for sure. As an entrepreneur, you know, an entrepreneur that tells you it's cakewalk is lying to you, but man, it's my baby, and it's, you know, it's a totally different thing. It's a difference between somebody else's kid crying in a restaurant when you're like, somebody shut that kid up, and your child crying where you're like, what's wrong, baby? You know, same crying, but when it's your business, you would do anything for it. So having the freedom to schedule my life and live my life as I see fit is priceless. And so anyway, that's a super long answer. I want to hit it hard for 5 years on buying stuff as a sponsor, and then start to transition out to be more of a key principal and a passive investor.
Love that. Yes. And I think you'll achieve that, you know, if you keep your success going, and, you know, just it's hard work, right? You still got to put in the hard work and, you know, and grind every single day, you know, don't take any days off, you know, keep grinding, you'll achieve it, you know, write down your goals and you'll get there. So I have no doubt that will happen.
Awesome.
At the end of your life, how do you want to be remembered?
Well, I really want to build a legacy of a business. You know, my business is actually named for the initials of all my children, and I want to, but it's much more than the money. I don't want to just hand them a business. So my 9-year-old son is my oldest. We're going to start buying rental property this year. We're going to buy 1 rental house for him this year. Next year, we want to buy 2, year after that 3, year after that 4. And so he's going to have 10 rentals when he gets into high school, but he's going to have to manage that. Now, maybe we use third-party property management, whatever, but he's got to have the wherewithal on the accounting, you know, the marketing, all those things, so that when those kids are in their 20s, I can hand off a business to them and have them have the wherewithal. I mean, we've seen the story countless times with wealthy children that are pieces of garbage, frankly, right? They just don't have any skill set. They don't have any drive. So I'm really concerned about, now that I've created a nice lifestyle for my family, I don't want my kids to be completely inept. So I want to coach them. And so I want to be remembered for creating the next generation of competent business people that can continue to run and grow businesses. So that's, you know, that's it. I want to look back on my life and know that, you know, whether I live to 80 or whether I die next year, that I don't have any regrets of how I spent my time. And I certainly don't have regrets about how I spent my time really ever since I became a full-time entrepreneur. You know, I work hard. I have time with my kids, and I kind of balance everything out. And I really do enjoy every day. And I think if you enjoy every day for decades, you can look back on your life and say, I did what I wanted to do, and I don't have any regrets. So that's kind of the path I'm on. And I think part of that will just be infinite growth. I mean, who knows what opportunities are going to present themselves in the next 5, 10, 20 years if I, assuming I live that long. So I'm excited for those new opportunities, and I'm excited to try to raise my children as the next generation of competent business people.
There you go, man. I mean, I couldn't have said it better myself. And that's, for anybody that has children, I think that should be something that should be towards the top of your list, because I do agree with you. And there's a lot of wealthy children that, they take things for granted, frankly, like you said, and, they don't turn out to be the best, because, they feel like, everything was given to them. They don't have to work hard for anything. And, nothing was earned, necessarily. And so if you kind of plant that seed, for your children, then, it can lead them to even bigger success, as they grow older, because they're used to that, they're used to working for what they have, nothing was given to them, they work for it. So, man, that's a great answer. So, so yeah, you have provided us a bunch of information, a bunch of value, and not only for my listeners, but for myself as well. It's been awesome. Where can Commit to Wealth Nation go to contact you and find out more about you and your company, DJE Texas Management Group?
Best place is probably just the website. That's kind of the hub, djetexas.com. So that's Delta Juliet Echo Texas.com. I've got a lot of educational videos on there, a lot of content, a lot of, I have a blog where I post different videos, but I also post updates on the project. So you can see how we're doing on these projects and see the renovations and the turnarounds and things like that. I'm a pretty transparent person in terms of what I put out there. This is what we're working on. And so you can see a lot of stuff there. There's also ways to get in touch, with me on there. So by all means, feel free to reach out.
Okay. Well then, yeah, we'll make sure to put that in the show notes as well. So you said your website, and then, we'll make sure to have it on there. So, well, thanks again, Devin. I really appreciate it. Thank you so much for your time, and I wish you continued success.
Awesome, Juan. Thanks so much for having me on. It was my pleasure.
Thank you.